how long to build a dividend portfolio. So before we get started, make sure to hit that like button, also subscribes to my channel. Building a portfolio reduces risk. Why should investors build a dividend portfolio instead of investing in just one or two companies that they like the most? For one thing, investing involves a tremendous amount of randomness and luck. The world constantly changes in unpredictable ways, so even the best investment professionals are wrong around half of the time. If we invested all of our cash into a single company, even one with seemingly low risk, we will likely generate returns that are significantly different than the market's performance, for better or worse. Many investors do not have the stomach for this level of volatility, especially since numerous unexpected events could occur to put your capital at risk of being permanently lost. Remember Enron? What about Lehman Brothers? Going all in on any single company can have severe consequences. On the other end of the spectrum, suppose you bought shares of every stock in the market. For each company in your portfolio that experienced bad news, you would likely own just as many businesses experiencing unexpectedly good news. In other words, you would no longer be dependent on any single stock to drive your investment returns and dividend income. Your portfolio could weather a few unanticipated storms because it was diversified across a number of different companies. So long as America continues to survive and advance, there would be virtually no chance of your portfolio experiencing a permanent loss of capital. The market has historically appreciated over long periods of time and will likely continue to do so. Of course, it is impractical for an individual investor to buy shares of every company in the market without the use of exchange-traded funds, ETFs, but you can understand the advantages of owning more than just a couple of companies. Hold between 20 and 60 stocks. Many of the best investment professionals run concentrated portfolios. For example, Apple accounts for over 30% of Berkshire Hathaway's overall stock portfolio. They invest with conviction behind their top ideas, believing in Warren Buffett's statement that diversification is protection against ignorance. But as individual investors on the outside looking in, we do not have Warren Buffett's resources, connections, and insights needed to responsibly run a concentrated portfolio. For that reason, we prefer to spread our bets over a reasonable mix of different stocks to avoid shooting ourselves in the foot with a concentrated bet that sours. The fewer stocks you own, the greater your portfolio can deviate from the market's return. So how many dividend-paying stocks should you own to maximize the benefits of diversification? Plenty of academic studies have tried answering this question over the last 50 years. A more recent study was released in a 2014 paper titled, Equity Portfolio Diversification: How Many Stocks Are Enough? Evidence from 5 Developed Markets. Notable findings were that a greater number of stocks are needed to diversify risk during periods when markets are in financial distress. Correlations between stocks are often the highest in this type of environment. Within the U.S., the researchers concluded that to be confident of reducing 90% of the diversifiable risk 90% of the time, the number of stocks needed on average is about 55. In times of distress, however, that figure can increase to more than 110 stocks. Overall, we believe creating a dividend portfolio with 20 to 60 stocks provides a reasonable balance between the need for diversification, a desire to keep trading activity low, and a limited amount of research time to devote to maintaining a portfolio. Investors with larger portfolios, a greater willingness to spend time on research, and an increased comfort from being more diversified may lean towards the high end of our recommend number of holdings. Portfolios filled with more speculative stocks facing a wider range of outcomes may also prefer to spread their bets over a larger number of holdings. Figuring out how much to invest in each position is the next step. Equally weight your holdings. It's tough to make predictions, especially about the future. The late Yogi Berra, who played professional baseball and never shied away from sharing his unconventional wisdom, could have been explaining the reasoning behind our next portfolio construction guideline. When creating a dividend portfolio from scratch, we prefer to roughly equal weight our positions because it is hard to know which holdings will be the best long-term performers. The stock market is quite efficient in the long run. This largely explains why so few active fund managers, who spend millions of dollars on research each year, have outperformed their respective benchmarks over time. In fact, S&P found that 95% of all U.S. active stock fund managers underperformed their benchmarks in the past 20-year period through 2021. Over the years, we have met with several portfolio managers of funds that have impressive long-term track records and conduct world-class research. None of them could escape the inherent uncertainties that can make investing so difficult. In fact, some of these managers shared with us that they could never predict which holdings would do the best any given decade. The bulk of their outperformance was driven by only a couple of holdings as well, with around 40 to 50% of their investment ideas ultimately failing to work out. Invest no more than 25% of your portfolio in any sector. Owning more stocks can reduce risk, but investors can still end up with poorly diversified portfolios if they are drawn to certain types of stocks, and consumer products with familiar brands, or investing rules, and only buy stocks with price-to-earnings ratios less than 12x. A dividend portfolio holding lots of stocks that have many shared characteristics may not be adequately diversified. This is because stocks from similar industries are often sensitive to the same factors and move together in the market. They are highly correlated. If a shared factor, such as interest rates or the price of oil, becomes unfavorable, your portfolio could significantly underperform the market. Picking stocks from different sectors and industries helps diversify away this risk. When some sectors are struggling, others are likely doing well. The pie chart below shows the sector breakdown of the S&P 500. You can see that only one sector, information technology, accounts for more than 20% of the overall market. What do you think of my video? Let me know in the comment section below. Thanks for watching my video.